Happy New Year, first of all.
Absolutely. Happy New Year to you.
So just to introduce ourselves, my name is Valeriy Solo. I am a realtor here in the Charlotte area, North and South Carolina. I've been doing it for 18 years. And today, my guest is Jeremy Moore. He's a mortgage broker, and I'll let him tell about himself a little bit. So, Jeremy, could you tell a little bit about yourself, where you come from, your background, and what you do in the real estate industry?
Yeah, sure. Thanks, Valeriy. Thanks for having me on. I appreciate it.
Yeah, thank you for being
here. So my name is Jeremy Moore. I am the president of livemoorelending. We are the in-house mortgage lender for ERA Livermore Real Estate Brokerage. I've been in the industry about 22 years.
Okay.
I've been in the banking and lending industry for about 22 years. The majority of that has been in the lending side of the business, but I also worked in the banking side for a while, in retail banking and also commercial banking. So I've been a residential mortgage lender for, out of those 20-something years, probably 16 of those.
Okay.
I've also been a commercial lender as well, so for commercial real estate as well. So I have a little bit of a background in that. I'm originally from St. Louis, Missouri, and just moved my family down here recently, as you know.
Wow. Yeah.
And so we're excited to be in Charlotte and excited to be working with ERA Livermore and happy to be here today.
That's awesome. So it sounds like you've got a pretty wide breadth of experience between residential, commercial, worked for some of the big banks, and then you being the president of Livermore Lending, did you guys recently open up that mortgage brokerage, or when did that come up?
Yeah, so we did. So my father, obviously, is the owner of ERA Livermore. And a couple of years ago, when I was in St. Louis, I had started a startup company, a technology company that myself and some colleagues of mine created. And we had that for several years, and it was a fantastic company. I really enjoyed it, but we ended up selling that company. And after the sale of that company, my father asked me what I was going to do next.
Yeah.
And just through conversation, he was looking for something. Basically, he just asked me, "Hey, is there something that he could do inside his real estate brokerage firm through a mortgage entity that would help the agents of ERA Livermore and the clients of ERA Livermore?" And so that was the genesis of it, Valeriy. I mean, he asked me, and I said, "Hey, this is a way we could, leverage the mortgage, entity, and basically, implement it into the ERA Livermore family."
Yeah, that's awesome. And that's awesome, you guys working together as family. That's rare to see, especially it being successfully done. So that's always an inspiration. And you speaking, I just realized a parallel that I hadn't seen before, where my father also, I grew up in a construction family. He wanted to see what I could do in the family business, so he nudged me towards real estate, and I got into it. So that's kind of interesting.
Yeah.
And just out of curiosity, as an aside, the company that you started up, was it in the fintech space, or?
It was a fintech, yes.
Oh,
absolutely.
nice.
It was a fintech, yeah. So what we did, just to, real briefly, is we saw a need, years ago where, everything is going technology, right?
Oh, yeah.
And the mortgage industry, the banking industry is no different. But we saw an actual opportunity with the mortgage broker, right? The kind of the smaller mortgage broker, the wholesale broker, where, for them to continue to compete with the bigger banks, the bigger lenders, they had to adopt some sort of technology, right? But they don't have the capital, right, to necessarily pay for these big technology,
the solutions.
Exactly.
Yeah.
And so what we did is we decided to create a digital mortgage platform.
Okay.
That was complete with a point of sale, right? It was like I said, it was digital in the clouds, right? So they could adopt it, and a point of sale application, and a pricing engine.
Oh, wow.
Right. So the pricing engine, if they put a scenario in, would price it with all their lenders.
Oh, wow.
So they could see it with one push of a button instead of going out to each individual website.
So you helped create an app or technology that will streamline the process for the smaller mortgage brokers.
Exactly, at a price that was more affordable to them. So
which is great. As a realtor for 18 years, nothing against the big banks, but I always tend to recommend different brokerages to my clients.
Right.
As far as loans, and I always tell them a loan is a product, just like anything else. I would recommend at least 2, if not 3, different opinions on it. And from my experience, the smaller brokerages, they often are able to, get better pricing, better deals, and they move a lot quicker. And in today's market, that's an absolute must, because if a property hits the market that's very hot, it's going to move quick, it's going to have multiple offers. Oftentimes, if you're competing with cash buyers who can close in 2-3 weeks. So having a lender that can move quickly, the big banks, from my experience, move very slow, like dinosaurs. So smaller brokerages, from my experience, are able to move a lot more quickly. And I guess, what's your take on that? Have you been in situations where you've had to come through and push through a loan pretty quick and got it done successfully?
Yeah, so it's a great point. And
Yeah.
and to be, completely frank, I have worked for all the, bigger banks, worked at Wells Fargo, worked at US Bank, worked at some larger mortgage companies as well, right? And so
Yeah.
that's really why when we started this company, I entered in as a broker because of the ability to give lower rates and to move quickly. So to answer your question specifically, yes. I mean, there are several times where my clients, when they're in a competing for a potential home purchase, they can go in and have a closing date, 10, 15 days
That's very aggressive.
faster than somebody who's at like a Wells Fargo or a Bank of America or just a larger bank.
And sometimes that will make or break the deal.
That's exactly right. And so, as you know, as an agent and from a client, when you have multiple offers, the seller is looking for little subtle differences that may sway them in their way.
Exactly.
Is there more down payment? Is the cash, like you said, but can you close quicker?
Exactly.
And that's what we do. And at livemoorelending, we won an award through one of our lenders, United Wholesale Mortgage, UWM, which is the largest mortgage lender in the country, not just wholesale, just overall largest mortgage lender in the country. We are one of the top 150 clients, because we had an average of, from submission to underwriting to close date, of 12 business days.
Oh, wow. That's
So
an average?
That's our average.
Oh, geez.
To clear
That's
and close.
impressive, man.
It's crazy how fast
Definitely
we can go.
deserves an award.
Yes. So we're very proud of that. But, again, back to your point, that's why, because of my experience and my tenure in the industry, I've seen all the different mortgage, models and for what we were doing, I do believe that the brokerage, the small brokerage or the mortgage broker really does add more value to the client and to the realtor than the bigger banks.
Yeah.
Now there are, obviously, in any situation, there are, negatives and positives,
Yeah,
right?
yeah.
And so there are some positives to working with bigger banks, et cetera. But for the most part, if you look at them both and you outweigh them, I think the mortgage broker comes ahead.
Yeah, and that's what my experience as well plays out, being out in the field. So
Yeah, good.
that's good to know. Well, I think it's a good little intro, and just to respect your time, we'll go through some questions that we had. And,
Absolutely.
Hopefully get some good insight here.
Fire away. I'm ready.
Great. So let me just pull these up.
Sure.
Sorry for the, fly by the seat of the pants preparation. All right, so initially, and this is just going back to the basics, for someone that's new to buying a home, can you explain the basic steps of getting a mortgage? And what are some big misconceptions that people have about qualifying for a loan?
Yeah, so I would say, the basic, I guess, to get a mortgage for a first time, home buyer or anybody who's interested in looking at mortgages, it's pretty simple. I mean, the first thing you need to do is obviously contact a mortgage lender, right? Maybe a referral from your agent, whomever it may be, right? Contact the mortgage broker. You're gonna have to fill out an application, right? Either speak to them via phone. I'm still somebody, I've been in the industry for so long. Maybe I'm, maybe I'm an old guy. I don't know, but I there are times where I still like to speak to people over the phone or in person.
Oh, yeah.
Just because it's a huge investment, and I think it's it's really important for people to work with people they trust.
I totally agree with you. For something as big as a real estate purchase, which for most people is the biggest investment in their lives,
Right.
You want to have at least 1 or 2 conversations with the person that's going to help you finance that. Have with a human connection and get to know each other, because it's also, there's business and numbers, but there's also an emotional aspect to it, where you want to help them as a lender, fulfill their dream of home ownership. So.
That's exactly right, and that's where that trust factor comes in, right? Somebody that understands what you're trying to do for you and your family, and helping you attain things that you're trying to attain for your family, right?
Yep,
and so
exactly.
I think it's important to get to talk to somebody. But regardless, if you talk to them via the phone or whatever, you're going to have to fill out an application. Okay, that's the most important part of the process, because filling out that application is going to give the lender and the broker a really good understanding of what your situation is, right? And then based off of some simple questions that you're going to answer, employment, right? You got to have a 2-year working history. It doesn't mean you have to work at the same place for 2 years, but they like to see that you've been in that industry and that job for 2 years, right? So they're going to look at that. Then they're going to look at your income and make sure that, hey, when you're out there looking for a home, how much can you afford, right? Which is extremely important. So once you fill out the application and start, kind of divulging that information, the mortgage broker can then go in and look at it. And then what they'll do as a mortgage broker is they'll come back and say, hey, based off of the information you provided, credit scores, income, employment history, residence history, need a 2-year residence history, right? Again, same as employment history. Don't have to be in the same place 2 years. We just need a 2-year history of it. So we got to record that, right?
Yeah.
Once we get that information, then what we'll do is we will calculate what your purchasing power is, right? That's what they call that, purchasing power. Right?
Now, I know it varies case by case, but just ballpark average, what, I guess, how do you determine purchasing power? Is it a certain percentage of income? Okay.
Yeah, great question. It's called debt to income ratio.
Okay. Typically DTI.
DTI, right? So maybe like a lot of industries, I don't know. Like I said, I've been in the banking and the mortgage industry, the lending industry my whole life, but there are tons of acronyms in this industry, right?
Yeah.
It's just every time
Hard
you turn
to
around.
keep track.
Yeah. So DTI stands for debt to income ratio.
Okay.
And that's a very, very simple mathematical problem. It's not hard to do, right? It's a formula, right?
Okay.
It's what are your minimum monthly obligations, so minimum monthly liabilities that are reporting on your credit, to your credit report.
So any kind of credit card
auto,
debt,
revolving, installment loans, any type of auto loans, credit cards, personal loans, land loans, mortgage loans, whatever that may be, right? Any of those, we take the minimum monthly obligation, right, and we divide that by your gross monthly income. Okay, and we add in the new potential house payment. Right. So, for example, if it's a simple math, $100,000 home you're buying, the new payment's $500. Right. We would add in whatever your current monthly obligations are. Add in the $500, divide that by your gross, so before taxes, your gross monthly income. That gives us a percentage, and it varies per product, but most of the time it's got to be somewhere around underneath that 45% DTI. And if you can do that, then that's how we factor what your purchasing power is, right?
So not in every single case, but for the most part, the house payment and any other debts or monthly payments from credit cards or car payments, anything that reports on that credit.
Correct.
All of that added up can't be more than 45% of your gross monthly income.
Correct, for conventional products.
For conventional products. And obviously there's exceptions, sometimes lower, sometimes higher, depending on credit scores and a bunch of other factors.
That's absolutely correct. Compensating factors are what they call that. So if you have a bunch of reserves, like financial reserves, right, or you have a really high credit score, right, or you have an excellent payment history, those things can also, so sometimes you can get into the 47s, 48 percentages.
I was actually going to ask, what's the highest DTI that you sometimes see?
Wow, I mean, I have seen probably up to like 49% on a conventional product. But again, that was because somebody had great compensating factors, right? They also had loan to value is a big factor of that, right?
That
LTV, so you know what you actually owe against what the house is worth. So if the house was 100,000, you put down 50, your LTV is 50%. So that's a big factor in, okay, the debt to income may be at 49, but they know that you already put down 50%, so you already have equity of 50%, right? So it's gonna decrease. It's all based off of the default ratio, like, you know, how they could do all their amortization schedules and the default thing. So
makes sense.
That's where they came up with those ratios. Not to get too down a rabbit hole, but
no, please do.
They do vary off a product, right? So FHA, right? We can get into that a little bit more.
That actually is going to be the next question is what is the different kinds of loans? And I know there's a bunch that run the gamut, but typically for the most part, what do most buyers look at when they're trying to get a loan? You know, you mentioned FHA, conventional.
Yeah, there's really 3 or 4 that pretty much everybody goes with. It's going to be the conventional, which is probably the most popular, right? Then you have FHA, which is just basically backed by the government. Just a percentage of that loan is backed by the government. So if they default, the government will pay the lender a percentage of that loan back.
But because it's backed by the government, there's extra rules and requirements that are government
That's absolutely true. Yep.
So FHA is a little less flexible than conventional loans typically. Or does it depend on the situation?
Depends on the situation. So, for example, and let me just finish the other question. FHA, then you have a VA, which is a veterans, right? So if you're a veteran, a vet in the Army.
But you have to be military.
You have to be military or ex-military, right? Veterans administrative. And then a USDA, which is again, a government product for rural properties.
But that's only specific areas that are USDA qualified.
That's correct. FEMA, right? The FEMA they have a map which denotes which properties are eligible for USDA,
Okay.
which is 100% financing,
Okay.
and so is VA, 100% financing.
So if you can get those two, those are typically probably the best loans to get. But that's, you have to be either in the military or buy in a specific area. So most loans end up being conventional or FHA.
Most loans do, and
Okay.
and let me just kind of qualify something. I've said this for years. There are no bad products, right? Just people were put in the wrong product, right? So I go back to my point about filling out that application,
Yeah.
and making sure that your lender or your broker has the full understanding of your financial picture and your work history. Because if you have a good loan officer or a good broker, they're going to go in and they're going to say, okay, this is the financial situation. This is what they're looking for. This is going to be the best product for you.
Okay.
So that's why it's important to find somebody you trust and somebody that's been, has the knowledge to understand, to be
Yeah.
able to look at that person's specific financial situation, not only their financial situation, but what their overall goals are.
Yeah.
And that way, that loan officer, that broker will know what product to put you in. So for example, just because you're a vet or you're in the military doesn't always mean that the VA loan is the best product for you, right? It just doesn't mean that.
Yeah.
So that's why we go back to the very first question of, what are the basics? You got to make sure when you're filling out the application that you're putting all the information in there and filling it out as accurately as you possibly can. I use this a lot. I came up with this line and I like it. I've been doing this for 20 something years, but I came up with this line because a lot of times, over my last 20 something years, I've worked with, thousands of borrowers. And I came up with this because it's kind of like I'm like an attorney. Now I don't make the money attorneys do sometimes, maybe not all attorneys, but and I didn't have to go to school as long as they did. But it's like this: if you listen to attorneys, it's like it's not what I know, right? It's what I can prove. So for example, if you're self-employed, and you make $600,000, but you take advantage of the self-employment, right, benefits, and
As most self-employed people do.
that's the benefit of it, right?
Yeah.
And they only list or they only claim $100,000. Well, I know you make $600,000, but I can't prove that.
Yeah.
So I can only qualify you off of your tax returns and what you've claimed to the IRS,
Yeah.
right? And sometimes people get frustrated about that, which I understand. But the bottom line is that's what it is. So it's not what I know; it's what I can prove.
Yeah.
And then the next one is tell me everything up front, because I'm going to find out anyway.
Yeah.
And usually by the time I find out, it's too late to do anything about it, right? So if you think about that kind of stuff, that's how. And I try to. I don't say that to all my clients, but in some way I kind of convey that message.
Well, it's interesting that you bring up those 2 points because in the self-employed sphere, I have a lot of clients that are self-employed, and I tell them, listen, I understand you want to write off all your expenses, but you're either going to have a pretty big tax bill, but you'll be able to buy a house, or you'll have minimal tax bill, but you're not going to get a house. Because if you do all those write-offs, like what you said, you can only go off of what can be proven as income. And I've personally seen what your example, like somebody cleared 400 or 500K gross, but on taxes only made 92K clean, and he couldn't get the loan that he wanted, even though he had the money for it.
Even though he could afford it.
Yeah, even though he could afford it.
And as an agent, you know that very well because you guys are self-employed people.
Yep,
So right?
absolutely. And the other thing I was going to say is a knowledgeable lender like yourself knows that in certain aspects, there's things that you can write off to minimize your tax liability, but that can still be counted back towards your income, certain deductions, whereas there's other expenses that will hurt you. So it's good to talk to somebody that knows what they're talking about just to make sure you're on the same page as far as trying to get qualified for a loan. That's great stuff.
And then I think the second part of your question was what were some misconceptions?
Yes, so what are some common misconceptions about getting a loan?
You know, it's funny. I think the biggest misconception is, there's several, but the biggest one is you have to have a 20% down payment, right? You don't have to have a 20% down payment. Not far behind that or close to that is your credit score,
Okay.
right? If I don't have a perfect credit score, I can't buy a house, both of which are not accurate,
Okay.
right? If you're a first-time home buyer, there are special programs out there for first-time home buyers. If you qualify, and there are some hoops you got to jump through, or some obstacles you got to qualify for, criteria you got to meet to get 100% financing. But you can get 100% financing.
Oh wow!
And then if you can't get 100% financing, or you don't want 100% financing, because sometimes people don't want 100% financing because the rate's a little bit higher. Because again the risk of default is higher with 100%, in the MI, etc. But FHA, for example, you only have to put down 3.5%.
Wow.
Okay. Conversely, Fannie Mae, who is a conventional, they said, well, we need to combat that, so we're going to come up with a 3% down for first-time home buyers.
Wow.
And the first-time home buyer definition doesn't necessarily mean you could have never owned a home before. That's not true anymore.
Okay.
You just couldn't have owned a home for the last 3 years.
Oh wow.
Yeah. So if
relatively short period.
so if you've lived in 3 or 4 houses, but you've rented for 2 or 3 years,
Yeah.
I think it's 3. You still qualify for that first time home buyers thing, right? And VA and USDA do have 100% financing options as well.
And on top of that, isn't there programs that North Carolina offers
There
for
is.
first-time homebuyer down payment assistance programs? And do you work with those?
I do. So it's interesting. So there are several different ones.
Okay.
The biggest and the largest one is the North Carolina Housing Finance Agency. Okay. And that's they have those types of grants and programs for 100% that will also give you closing costs as well.
Okay. Yeah. So it seems
It's like
like
up to 15,000.
free money, like no-brainer. What's the downsides?
Yeah, great question. So there are 2 downsides that I've always and when I speak to my clients, I make sure they understand this. Okay, so when you enter into or you take out 100% financing, right, you're gonna have a higher rate first of all. Okay.
Okay.
You know,
Like approximately how much higher? Like 1%, quarter of a percent?
it's probably depending on the credit score as
Okay.
well, right? So I didn't get into the credit score, but just to backtrack real fast and answer that question. The other one is you got to have perfect credit score. You don't. FHA is 580.
Oh wow.
Okay.
Well,
Now,
you guys work with as low as 580.
580,
Okay.
and then for conventional it's 620.
Okay.
So if you're out there, you're a first time home buyer, you're renting, you're thinking about, hey, I can't qualify. That's not true.
Okay.
Contact.
Always
your
worth a
local-
look.
Yes,
And even if your credit score is not there, you guys offer tips on, hey, you're not here yet, but do these things, and in 3 months, your
that's
score will
exactly
come
right.
back up. Okay.
I got a couple clients right now where I have the ability to go in and say, hey, if you do these specific things,
Yeah.
your score should go to this.
Yeah.
Okay, so great point. So we also
Okay.
do a lot of that. We may not be able to buy right now,
Yeah.
but you might get yourself in a position to buy in 6 months. So great point. So then back to what we were talking about, which was what? What were we talking about?
So we were talking about the down payment assistance program,
Right,
the
so down
negatives.
payments, the negatives of it. So potentially higher interest rate.
Okay.
Okay. Some you have MI, some don't have MI. It just
Okay.
depends on the program.
Okay.
They're
And
grants.
MI is another
Mortgage
acronym.
insurance, yes.
Okay.
So mortgage insurance. So if you put down any amount of money less than 20%, you will incur what they call PMI, private mortgage insurance,
Okay.
or MI, mortgage insurance. It's the same thing.
Same thing.
Doesn't
Okay.
matter. No. Now FHA product always has MI.
Yeah.
Can't get out of it.
Yeah.
Okay. So no matter what, you have it. But anyway, conventional, it doesn't. And then, but going to the negatives, a big negative and one that you really need to think about. And a lot of times you asked about, I think you said some misconceptions or mistakes that maybe buyers make. I make sure that I very much clarify that when you go into or enter into these 100% financing, there is a clause in there that says if you refinance or sell for 5, 10, 15 years, you have to pay that back.
Yes. Okay, that's a good point and a good reminder.
Yeah.
These free down payment assistance programs, this free money, it only becomes free after a certain period of time. I think it varies by program, but I know
does.
some of them you have to live 10 years, and then the 11th year, 20% gets reduced, and then by the 15th year, it's all forgiven.
Right.
Some of them 3 to 5 years.
Some
you
are
have to
3 to
live there.
5, but it's not even just selling it, or it's also refinancing.
Or even refinancing.
Yeah,
Okay.
because,
Oh, wow. That's
Yeah,
a good
because
point.
now that loan has been paid off, right?
Yeah.
And so if you do sell it or you do refinance, you have to pay it back.
Yeah.
So you have to be very careful about that. And to my point about mistakes that buyers make, they get so excited about wanting a house that they don't care. Like they'll say, I don't care about that. I'm like, I know you don't care about it now.
Yeah.
But if your rate is 7.5, right, and then in a year from now rates go down
Yeah.
to 6.5, you're gonna want to refinance.
Oh, yeah.
And then in a year from now, you're gonna be like, wow, maybe I shouldn't have done this.
Then you'll be, yeah.
So it's
It's good to consider all aspects, and
Absolutely.
I guess it's good to have somebody with your experience to help guide and ask the questions that they don't even know to ask,
Right.
or imagine those kind of scenarios.
just make sure they're aware of it, right? So they
Yeah.
can make an educated decision.
Good stuff.
Yeah. Very good.
So we covered different kind of loans, credit score and preparation. I guess, do you have any tips on what people can do for just basic upkeep on credit score? If there's anything they can do before a loan application to increase their credit score, or just come apply and take it from there? What's your guidance on that?
Well, yeah, I mean, you can do it one of two ways, right? You can just apply, and we can get an idea of where your credit is, and then we can devise a credit increasing program if you need it, right? A plan if you need that.
Okay.
But here's some I guess credit tips, if you will. Pretty common stuff. If you have credit card balances, try to keep the balance 30% or less.
So not pay it off all the way.
No, and it's a great point. So people ask me like, I'm gonna pay it off all the way. I'm like, don't do that.
Okay.
Because if you pay it off all the way, and you don't put anything else back on it, the credit card company might close it.
Oh wow.
And if they close your account,
Yeah.
then your credit is actually reacts
negatively.
negatively.
Wow.
It's got adverse of it. For now, it only lasts maybe 3-6 months.
Yeah.
But it will drop.
But that's still okay.
It will drop. So I always advise my clients, hey, if you want to pay that down, pay it down to like 20% or 10%.
Yeah.
So like if you have a balance of like if you have a limit of $100,
Yeah.
right? Maybe pay it to $20.
Okay.
Don't take it, or even $5.
Yeah.
Don't pay it to zero, because if you don't put anything on it, it'll hurt you. So that's one
plus
thing.
the activity of them seeing you having a low credit balance, plus making payments, that's extra data that gets sent to the credit bureaus to algorithmically push your credit score
To
up.
increase the credit, that's
Okay.
correct. So
That makes sense.
the longer history you have, credit history, longer good credit history, on-time payments, things like that, right? So I would do that. And then, collections are terrible.
Yeah.
All right. So I myself, a while ago, I have Credit Karma. And I would always tell anybody, like, whether you're looking to buy a house or not buy a house, get some sort of, one of those products,
Like
Credit Karma,
monitoring
your
products?
credit,
Okay.
so you know what's going on,
Yeah.
right?
Yeah.
So
Especially
because,
in this day and age. with all the fraud
all
happening.
kinds of stuff, but also collections. Sometimes we don't even know we owe money, right? And then all of a sudden they pop up on your credit score and it's collection.
Guilty. It just happened to me, and I actually called and I closed the account. I shouldn't have, but that's the only way to refund the annual fee. But yeah, I had a credit card that I hadn't used for years, and then all of a sudden I get a notice like, "Hey, late payment, credit score dropped." I'll be able to get it back up pretty quickly, but yeah, like you said, sometimes people don't even know. So I need to sign up for the Credit Karma.
I would, and just monitor it, and then you can build credit. There's credit cards out there that are there specifically to help you build credit if you don't have any.
Okay.
Right? You pay it off every month, right?
Okay.
And they give you a very low
Balance amount, or
limit,
you can deposit cash.
Exactly.
For that.
There's CDs where you can deposit cash, and it actually acts as a trade line, and it looks like it's a bill.
Oh, okay.
Right, go to a bank or a credit union. They have these
cool.
things,
I
right?
didn't
So
know
you're
that
so you're building, so you're paying into this account, and they're reporting it as a liability.
So you're paying into an investment account.
And then at the end of it, they give you your money back.
That's awesome.
Isn't that a cool idea?
That's a cool idea.
So I was working at the bank years ago. Somebody implemented that. It wasn't my idea. I wish it was. But it's a great idea.
That's a very great idea.
And there's credit cards that that you can build that have a low limit that you build every month. So those are a little bit of some tricks of credit that you can do. And then of course the biggest thing is once you do enter into a purchase agreement, right? And you're in the process of getting a mortgage, don't make any large transactions.
Okay.
Don't go buy cars. Don't go buy
cancel the
furniture.
car purchase.
Don't do anything, right? You don't want to do
geez.
anything at all that's going to affect your credit score or your debt to income ratio.
You would think some things go without saying, but you'd be surprised. In my 18 years, I've seen and heard some stuff, and deals could fall apart because of a last-minute, splurge or a purchase from somebody that didn't know or wasn't told that. So
right, and people think sometimes like, hey, my credit got pulled. They're not going to pull it again, so they won't know about it.
Yeah, that doesn't happen.
No, they have something that that the mortgage companies that they monitor that. So anytime you open up an account or something, they get dinged. They know about it, so don't do it.
Okay.
So that's kind of covers.
And speaking of credit, one final question about that, and we can move on to the next topic. So I've heard that if you check your credit one time, it's okay. If you check your credit like one time a month, 2 or 3 or 4 times in a row, that's very bad. But if you check your credit multiple times within the span of like 2, 3, 4 weeks, it hits your credit negatively, similar as if you only checked it once. Is that true? If you try to get multiple estimates from different lenders and you have your credit pulled 2 or 3 times within a couple of weeks, does that impact it way more negatively than having it checked one time? What's your take on that?
Yeah, great question, and I hear that a lot.
Okay.
And I'll tell you what my take is on it. I don't know if I believe. So I've heard that. So the I guess the verbiage they're putting out there is if you're shopping for a mortgage loan, you have 30 days for your credit to be pulled a certain amount of times and not have it impacted negatively.
Yeah, exactly.
I don't necessarily adopt that belief. I don't believe that.
Yeah, it's always sounded dubious to me.
Yeah.
So that's what I'm just trying to see.
I don't personally believe that.
Okay.
What I would do is this, and this is what I tell my clients. Okay. Again, working with somebody that you can trust and they have the experience. Here's what I would say. You can get a pre-approval without having your credit checked. It's not. It's more of a pre-qualification. Let me decipher that. Pre-qualification, pre-approval.
Okay.
They're also two different things.
Okay.
Pre-qualification is, hey, I've looked at your stuff and we had a conversation and I'm giving you a pre-qualification. A pre-approval, a true pre-approval is you've given me all your asset and income documents. I've sent it into an underwriter. They've looked at it and they said, here you go.
And you've done a credit check.
And you've done a credit check.
Okay.
Exactly.
Okay.
But what I would say is if you're shopping around, okay, I would say have somebody pull it.
Okay.
Ask them what your credit score is. All right. And then say, hey, I've already had my credit pulled. This is my score.
Okay.
And if people call me and say, hey, you know, I need a pre-approval, I'm like, hey, have you talked to anybody yet? And they say, yeah. I go, did you get a credit score? They're like, yeah. I said, okay, what's your credit score?
Yeah.
And they'll give me that credit score. And I'll say, okay, I can give you a pre-qualification right now.
Yeah.
If you want a pre-approval, then I have to pull credit and I have to do all that. But my point is, I've actually told people, I'm like, look, I don't like people pulling my credit, right? Because to be completely honest with you, Valeriy, I don't think anybody really knows. Okay, there's different credit formulas out there. There's different credit things. Like, so I've heard it said from a credit person through my Advantage Credit, told me that you have like Windows 10 and Windows 11 and Windows 12. It's the same thing with credit, right? They have different versions and different score advantages. So the mortgage industry uses a different one than the car industry does. The car industry uses a different one than, say, even your Credit Karma or your credit cards now.
I've run into that a lot where people say, well, my score was this. Well, I'm sorry, the credit score that the banks go off of is saying this, and it doesn't always line up.
Exactly. So I always tend to be more of, hey, I don't like pulling people's credit unless I have to.
Yeah.
And then I'll say, hey, this is what I can do. This is what it looks like. When you get into when you enter into an actual purchase agreement, then we're gonna have to pull your credit.
Yeah. I think that's a good strategy to mitigate the potential negative hit. And I like your approach where checking if they have checked their credit, if they've pulled it, go off of that. Because they'll give you enough info to at least get them the pre-qualification so they can compare apples to apples.
Now, what I will do, just so that for a realtor, because I know realtors can get nervous and stuff. If somebody comes to me and says, hey, I think my credit might be like a 610, a 615, I'll be like, look, I can't give you a pre-qualification on that. I got to pull your credit. But if they come to me and like, oh yeah, I got a score of 800, or they said, oh, this guy told me it's a 700, 800, I'll be like, okay, fine.
Yeah, for the sake of the customer, not risking deposits unnecessarily if they find out later they're not qualified, because deposits, some of them are not refundable. So
and for the realtor, right? The realtor doesn't want to go out.
Exactly.
Looking at houses, so
wasting time.
Exactly. So if it's a margin, I'll say, hey man, I got to pull it. But anyway, I don't know the answer to that. I don't.
So how do we break up this credit bureau monopoly that this mafia has over the real estate industry?
If you figure that out,
that'll be podcast number 10.
Yeah, if you figure it out, let me know. I'll be more than happy to join in.
Awesome. So great stuff so far. I'm loving it. Just a couple more questions and we'll let you go. So I guess we can go towards the forecast. So 2025 home prices. Recently done polling of the 21 top institutions in the real estate industry, from Goldman Sachs to Zillow, Redfin, to Keller Williams, all the big players in the real estate industry, was asking about the pricing forecasts for homes. 19 out of 21 of them are positive, and they range from 0.6% increase to 5.5% increase. Average 2.9, around 3% growth is expected for property prices this year. And I was wondering, from your perspective, increase in prices for properties, what do you anticipate that's going to do for the mortgage industry side of things? Do you expect for less people to buy, more people to buy, for it to stay the same, or what are you guys predicting as far as the amount of loans that are going to be done?
Yeah, so it's an interesting question. And I guess it's good timing, but I got some information this morning specific to that question. And it's from the MBA, which is the Mortgage Bankers Association.
Sorry to interrupt and to cut you off. Just one last piece I'll throw in there, because it sounds like we'll be talking about the same thing. The other forecast I wanted to mention to you, the average forecast for mortgage rates, again, poll of 9 institutions this time, anywhere from 6.1 to 6.8%. 6.36 is the average that they anticipate for 2025 for mortgage interest rates. So all of that together, home pricing forecast and mortgage pricing forecast. What's your anticipation for 2025?
Pretty similar.
Okay.
To talk about the housing increase.
Okay.
I do predict they are predicting the same things in our industry. It's going to be
Okay.
somewhere around, they're going to increase a little bit more.
So there's not going to be any kind of bottom falling out recession type event. I mean,
No, I don't believe
mine
so.
is some kind of black swan, unexpected,
Right, pandemic
catastrophe.
or something.
Yeah.
No, I don't think so. I think those numbers are very accurate to what we're hearing in the mortgage industry as well.
Okay.
Like I was stating before, the MBA, which is the Mortgage Bankers Association, which is kind of our kind of I don't want to say governing body, but
Yeah.
the place we go to, is actually predicting that exactly that the housing prices are probably going to increase a little bit more.
Okay.
Because of demand.
Okay.
Right, and part of that demand, which is actually, I think, going to turn into favor for the buyers, is that home building is going to be down. Right, so home building, they're expecting home building to decrease in 2025. Therefore, it's going to be a better market for, I don't want to say the buyers necessarily, but I don't know if you know this, but evidently if they're looking at it from a standpoint of if 4 months or less, if a house stays on the market less than 4 months, it's considered a seller's market.
Yeah.
If it stays on the market longer than 6 months, it's considered a buyer's market.
Yep.
Okay, so they're anticipating, Fannie Mae and the NBA is anticipating, probably the same people you talk to, anticipating homes to be on the market for an average of 4.1, 4.2 months.
Oh, wow.
In 2025, which is going to create a balance, if you will.
Okay. Yeah.
Okay.
Yeah.
And then the lack of home building is going to create opportunities for people to buy existing homes because they're going to have to.
Yeah.
Which is going to create opportunities for the seller, which is going to be, I think, the big reason why that number is going to be right in the middle, which is balance. Which I
Yeah.
think anybody, I'm not an economist, but anybody knows balance is good.
Yeah. Yeah.
So,
Absolutely.
So I think the increase is going to be there. It's going to be a small one, 1%, something like that.
Okay.
But I think it's going to turn into a better market for buyers.
Okay.
Okay, which is good.
Yeah.
It's going to be good for our industry, of course.
Absolutely.
We have more homes. They're predicting that the purchase volume is going to rise to 1.4 trillion
Okay.
in 2025, which is up 8%
Wow.
from 2024.
Wow. So more people are trying to get loans.
Exactly right. So I think we're going to see, and the reason for that is also to hit on your interest rate question. So last year the Fed raised the interest rates by I think it was a full percentage point. The entire year, it came to one full percentage point, right? They're predicting this year that they're gonna cut it an additional at least 0.5%.
Oh,
Okay.
wow. Okay.
So to your point, rates today, I was in there this morning. I look at them every day. Just based off our conversation today, 20% down, perfect credit, $350,000 purchase price. Rates today were somewhere between 6.75 and 6.875.
Okay.
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 So if you figure a half percentage point off of that, give and take, you're down around that 6.1, 6.375. I think that's what you're going to see rates at this year. They may drop into the high fives. They may, right? But I think that's what we're going to be at. And the other thing about why I believe, why I don't believe, but why they believe that another factor of why the purchase volume will go up is the normalizing of interest rates.
Yeah.
People
finally
are starting to
get used
understand this is where we're at.
Yeah.
Right.
Which, it sucks, but at the same time, it's reality. Being in the sixes for 2025, to quote Chernobyl, like, not too bad, not too good, but I tell my clients that, first of all, a 30-year mortgage product is very unique to America itself. If you look at other countries, a lot of them don't amortize over that long, or they have crazy high interest rates. And we're still blessed with relatively low interest rates compared to some in the past. Yeah, the prices were lower back in the days when interest rates were 12, 13, 18%.
15%, yeah.
But the fact of the matter is, if you can utilize a bank to leverage yourself into an asset, a real estate asset, which in my opinion is one of the best investments you can make these days, but it's another topic. It's still worthwhile, even at the cost of being in the sixes for a mortgage rate. And speaking of the Fed, and I think maybe we can wrap up on this question.
Sure.
There's varying opinions on how they handled the rollout of the rate cut last year. Obviously, the politics of everything infused a lot of influence into how things were played out. Some people believe that the Fed, they cut too hard or too much, too fast back in September. They shouldn't have done a 0.5% rate right away. They should have done a quarter rate. Because it was interesting, going through August and early September, I remember the rates went down all the way to the low sixes in
High
anticipation.
High fives.
I hadn't even seen the high fives, but yeah. So in anticipation of the cut, because finance, the markets, they respond to future news as well. When the cut happened, things started going back up and up and up, and it just seemed like it was a wasted shot because the Fed, any little move, any little statement they make can move markets. So to do something as big as a rate cut and then have the impact not be as I guess impactful as they were hoping. I guess what's your opinion on how they handled that and how you foresee them handling this year, and what would you hope to see, and what's the final result that you anticipate potentially? Tell me the future. In a nutshell.
I'll tell you, when people ask me what rates are going to do, I'll tell you my go-to line is, if you've been in the mortgage industry, you know that. Well, if I had a crystal ball, I would let you know. But if I had a crystal ball, I'd probably have an island somewhere.
Yeah. I wouldn't be talking to you here
so
about mortgage rates.
I don't know what rates you're going to do, and if anybody tells you they do, they're crazy.
Yeah.
To answer your question, I will. It's a loaded question, only from the standpoint of I'm going to try to stay apolitical if I can.
Mm-hmm.
I think that, in my opinion, this is just my opinion, I think that the Fed handled the rates in general in 2024 very poorly. You kept hearing about all these rate cuts that were gonna be rolling out, and they just didn't do it. They didn't do it. Right? And then to your point, right around, what was it? September, October, I forget when it was.
Late August or early September.
Right around when it's coming down to election day, right?
Yeah.
And now here's where I'm going to be apolitical. I don't think it matters what side of the political party you fall on. Politics is politics, which is a whole other podcast in itself.
And we'll keep that separate.
Yeah, and that's a whole different podcast. That but I think that because it was an election year, to your point, they came in hard and said, "Hey, we're going to cut," because one of the biggest topics about the election was the economy.
Yep.
Right, and so I think the current administration decided, hey, we better make some sort of splash, and they went in and cut it that half percentage point. But to your point, what they then did was very quietly raise them right back up. Right now, of course, the economy and everything else has impacts on that, but the economy wasn't changing.
Yeah.
So they had to know.
Yeah.
That based off of the factors, the Treasury and the job report and all that, employment history, employment report, that they were going to go back up. So to me, it was exactly what you said.
Yeah.
It was a little bit of smoking mirrors. It was kind of, look at what we did.
Yeah.
Because I had people calling me up, a month after that, saying, hey, I want to refinance. I'm like, yeah, you missed that window. That window was 3 weeks long.
Yeah, that's a short window.
Yeah, we're back up to 6.8757%.
Yeah.
And so to me, it was a bit of a political move.
Yeah.
That really didn't help anybody.
Which is unfortunate.
It is unfortunate. Now, some people don't get me wrong, there are a lot of people who refinanced or purchased in that little window, and they were able to take advantage of that.
Yeah, of course.
So I thought it was poorly. I thought it was very, very handled very poorly. I thought they should have done a rate cut earlier in the year.
Yeah.
I am no economist, so whoever hears this, I'm not here. I'm not an economist.
Yeah.
Been doing this for 20-something years.
Yeah, let's armchair quarterback the Fed right here.
Yeah, I mean,
you guys.
Exactly. Monday morning quarterback, right? So, but my point is, I've been in it long enough to know that I believe a good, healthy economy. In history, the interest rates are around that 5%, 6%, 5.5%, 6%.
Yeah.
So I know everybody is thinking to themselves, oh my God, they're so high because they've only seen these 3 and 4%, which I didn't agree with 3 and 4%.
Yeah, I told all my clients for years, those are artificially suppressed, from the recession. They just didn't let off on the suppression. So everybody got spoiled rotten with these crazy, crazy rates. I wish I brought more properties back then, but it is what it is.
Exactly. But yeah, the rates today are still they're solid rates.
Exactly.
I mean, there are decades of 15, 12, 10%, 8%. When I first got into the industry, the interest rates were 8, 9%.
Yeah.
Right? And that was back in 2000, like 3 or 4. I mean,
even at those rates, God forbid they go up that high, if you look at the long-term value of a property between the tax benefits, the equity growth, potential renting, just as an asset, long-term still worthwhile.
Yeah.
Obviously, it's a lot harder because the qualifications are higher, income has to be higher.
Right.
But I think we can end on a positive note as far as like the equilibrium that we're hoping to see that will be good for both buyers and sellers. Being in the industry since 2006, right before the recession, during, after, I've seen all types of markets. A balanced market is the best.
Absolutely.
What we had pre-COVID, during COVID, shortly after, before the interest rate hikes was insane. And I don't think any professional agent would want to go back to that, where 20, 30 offers, crazy deposits that are non-refundable, sight unseen purchases.
Hundreds
It
of
needs to
thousands
be.
over
Yeah,
asking price.
it needs to be balanced, and I'm starting to see that more where properties they might sit on the market for a little bit longer, but they still get the price they're asking for. Things just move at a little bit slower paced. And if I'm recalling correctly, I believe 6 month supply is a balanced market from a real estate standpoint, meaning if all the houses for sale now was all that was for sale, it would take 6 months to sell them all for all the buyers that are looking. Right now, I think last I checked, we're either at a 2 or 3 month
3 months,
supply, which is crazy seller market.
Right.
But it's gonna slowly move back to the other way. So
Yeah, which is what they're predicting.
Yeah,
Hopefully.
yeah, that's what they're predicting.
But yeah, and thanks for having me. But I do think that this year, I'm hoping that the administration will take a more methodical approach to the rates. I don't think we're going to see too many rate cuts. I think it'll only be a quarter here, a quarter there, maybe an eighth here, eighth there.
Yeah, unfortunately, I feel like the mishandling of the levers up top, especially during the COVID years where they just gave out way too much money that was not necessary, we have to pay the price for that a little bit. So I think we will see some pain in that regard as that works itself out of the system, as long as no more bad decisions add to that. But once we go through that, I think it'll even out and all the prospects look up. So I'm looking forward to it.
And I think that anybody who's watching or anybody out there, it's a good time to buy.
Oh yeah,
it is.
Oh, yeah.
There's no reason not to.
And for anybody that's looking to buy, I'll help you buy, and he'll help you finance it.
Absolutely, give us a call.
All right, Jeremy.
Larry,
thanks so
thank
much,
you very
man.
much.
It's
I
great
appreciate it.
convo.
It's
Looking
great being
forward
here
to
with you.
more. Yeah,
All right.
yeah, that's awesome.
Very good.